We'll get a rate hike. It'll be the 8th hike. And by the way, the economy seems to be stronger and more inflationary after 8 hikes than it was before. So I think it is an interesting milestone to suggest that the Fed is not even close to being done raising rates. But for this week, obviously everyone will look at the press release, the interview, what the words are, which words they're putting in, which words they're taking out. That's always sort of a big game around the FOMC. And of course, they'll add the dots for 2021, and that'll be interesting to see. So from my perspective,
when you say dots, just for everybody else, that just means showing us where they think, the members think, you're going to see rate hikes for 2021.
Yeah. So back in 2012, they created the dot plot where it shows each FOMC member's individual projection for where the Fed funds target rate will be so many years out, as a way to create transparency and this sort of guidance going forward. And it's always a game to see how the dots are moving. But it's interesting that the Fed has been suggesting 6 more hikes over the next couple of years through the dot plot, and those are only suggestions, of course. Those are not official Fed projections. The market's been at 3 more hikes, and so the markets generally over the past few years have had it more right than the Fed. But I think actually in this case the Fed has it more right, and the market has repriced itself over the past 3 weeks pretty sharply. And
Wait a second. What are you saying? You think that the market is not getting it right this time around, meaning it's running up despite the fact that these rate hikes are here, and the Fed is going to be the one that's right in the end that raises rates even more sharply than the market's anticipating?
Yes, I think the market has been a little bit too complacent about how many more rate hikes are coming, pricing in only 3 more over the next 2 years. Prior to Labor Day, now it's up to 4 more. So the market is repricing itself. This is why the 10-year has gone from 280 to 310 in only a few weeks. And maybe it'll go up to 3.5 over the next year or so, as the Fed probably has more wood to chop than the market expects.
Hank, even if that's the case, even if we do get to 3.3, 3.5%, we are continuing to see the stock market make gains at this point. Could you have both those things happen?
Yeah, absolutely. The Fed couldn't ask for a better framework here, because we have fiscal stimulus from tax reform, increased spending, regulatory rollback, and that is providing the platform for normalization. You just couldn't ask for a better setup. We don't expect any surprises with this Fed meeting. Chairman Powell will acknowledge the economy is strong. He might talk about a few potential headwinds, trade wars. And as usual, he'll say the Fed will be data dependent.
Jurrien, that's a really interesting point, this idea that this is the perfect scenario to have this fiscal stimulus coming in. Usually you have a more cyclical situation where the Fed's trying to raise rates after the fiscal stimulus is gone. Could this make it an easier landing period, or do you think it's going to be the same situation where oftentimes an economy is hampered by the Fed raising rates?
Yeah, so historically, it unfortunately has been the Fed that has often sort of killed the expansion, if you will. And it's not necessarily the Fed's fault. It's just the Fed, during what we call late cycle, when the economy starts to overheat and becomes more inflationary, usually the Fed will have to chase the inflation rate higher, because that's part of its mandate, of course. And then it hikes too many times, and you get an inverted yield curve at the same time that you have the Fed's policy rate well above the so-called neutral rate, right? So we shouldn't compare the policy rate to some arbitrary rate like 0. It should be compared to what would be a neutral rate. And the neutral
we may be
rate,
approaching that right now. If you're looking at a neutral rate, if inflation's 2% and you're getting it to 2%.
Well, so that's my point. So the neutral rate, the goalpost seems to be moving. I mean, the Laubach-Williams R-star estimate was revised higher by almost 85 basis points over the summer. So maybe neutral is closer to 3 and not 2%. And if it's 3 and the Fed needs to get moderately restrictive, we're looking at a Fed funds rate at 3.5, whereas the market was pricing in, about 275. So it is a moving target. But the good news is that, as the natural rate goes up, it allows the Fed to raise rates further without damaging the economy. And therefore, if the curve were to invert next year, it may not be as damaging as it might have been in other cycles.
So, Hank, what are you telling investors to do right now? People are are sitting around realizing that the Dow's been hitting new highs, S&P's been hitting new highs. It's all been happening in this environment. Are you telling people to go ahead and double down and buy here?
Well, we think investors should have their maximum exposure to equities and be confident in that. And whether you're a balanced investor and you're 60-40, you should be at 60% equities. Or if you're 100% equities, that's exactly where you should be. I don't think we're in the late stages of this economic cycle or market cycle. We're certainly not in the early stages, but we may very well be in the middle innings. And when you've had tax reform like this, it is not a sugar high. It has a multi-year effect.
That's not everybody says that, Hank. I'm writing that down.
Oh, I know that.
Oh, I know. I
Well,
know you
look.
know, and I make sure that I remember the people that say one thing and the people that say the other. So I'm going to remember you said that. I don't know what's going to happen, but I would think you change structurally the competitive landscape globally for U.S. companies, and it's almost like the people that call it a sugar high are the ones that said it wasn't going to work even for the first year. So they're clinging to their denial.
Joe, when President Bush gave everyone a $500 credit in 2001, that was a sugar high.
Right.
Then in 2003, he lowered capital gains, dividends, the top marginal rate. That had a multi-year impact, and that is where we are today.